Hey everyone, this is Dan with Data Trend. Today is Monday, March 14th, 2016. It's about 3:30 p.m. or so. I am in Central Time right now. I had some personal things come up, and so I'm in the Central Time zone. So the market's closed here about a half hour ago. This is roughly the same time for the daily video. It's just that we're in a different time zone. So the first thing we're going to talk about today is we're going to run this daily video a little bit differently. So right now you'll see we're looking at SPX, the S&P 500 index, and many of you know that I trade this as well. And we were recently taken out of the April RUT CIB. Today I went ahead and opened a new CIB, but I did it in SPX because the only expiration series to use was the April 5th, in my mind, the April 5th. And I had some existing trades in RUT, so I went ahead and opened it in SPX instead because it was easier to avoid overlapping those two trades. And I've also done some back testing in SPX recently, and it seems pretty favorable. So I thought we'd go ahead and give it a shot this month. So the trade that we opened today, we'll take a look at it in a moment. But this is a daily chart of the SPX, and we'll go ahead and just talk about the technical levels first. Then we'll hop over and look at that position, and we'll talk a little bit about what's different about it as opposed to the RUT trade. So as everybody probably knows, this is similar to the RUT chart in that we've had this really big rally off of the February lows here. And in the SPX, this was from 1810 up to about 2023. And that's about 11.5% or so this move that we've had recently. On Friday, we had this big push higher day. There is actually an unfilled gap down here below the Friday low. And then today we just kind of had a low energy churning day ahead of the Fed on Wednesday. So the position has expiration break evens as it sits right now up around 2040 and on the downside down around 1940. And there's a lot of attention being paid to this level here, which is this shaded box, which is around 2040-ish. We could call it 2040, 2045, and even up to 2060 or so. People are watching this level because this was the gap lower at the beginning of the year on January 4th, the market gap lower, and it raced lower from there, and we haven't been up to fill that gap. And so people are paying a lot of attention to it, and it wouldn't be surprising, I suppose, to see the market trade up and through to close that gap at some point in the near future, just based on the proximity. So this market is also like the Russell in a bear market, more or less. It's sitting right at the declining 200-day simple moving average. This is the 50-day simple moving average, which is also declining, and it's in a short-term rally within the context of this longer-term downtrend, or maybe it's just a distribution. But we have the market sitting right up around potential resistance. It is up above the 5-day simple moving average, the 10-day and the 20-day, and those are all slipping up. And so we have this short-term strength in the market, which is fairly similar to the Russell, but just not quite as strong and fast on the move up. If we drop down to the 65-minute time frame, we see this is similar type of patterns. We have this pattern of higher highs and higher lows. There's nothing new there, and we can agree pretty much on a shorter-term time frame that this is generally a bullish chart. We have the market closing here today up at about 2019.64, was essentially unchanged. And this level here around 2010 acted as a little bit of support today when we had a little bit of a pullback and the market pushed up higher from there. So we're going to want to watch this level going forward tomorrow. If we break through that, the market has a potential to pull back a little bit lower in here, maybe down into the neighborhood of 1990, 1995. There's the unfilled gap from this morning. And a deeper level below that would be maybe 1970. And I say that violating this 1970 level and holding below it would create reason to, maybe expect a little bit of a deeper decline or at least a more significant slowing in this uptrend. So for the time being, we're going to just kind of assume that prices might kind of chop sideways to higher. But violating this 1970 level and holding down below that would be reason to suspect that maybe higher prices aren't in the cards anymore, at least on a short-term basis. So let's hop over and take a look at the Analyze tab. So this is the April 5/16 CIB. So this is in the April weeklies. These options have 46 days to expiration. And I have the 1925, 1990, 2055 SPX butterfly, and that's paired with the 202.5 SPY call. And so it ends up looking in a position like this. The one thing that's different, at first glance, is that this butterfly is about 65 points wide. It still fits the risk-reward guidelines. And the deltas are a little bit different because we're talking about SPX deltas as opposed to RUT deltas. So the position as it sits at the close today, that's this price slice right here. We have a delta of negative 2.08, and this is an SPX, gamma negative 0.01, theta is $8.12, Vegas negative 28, and an open profit of about $9. So nothing to get too excited one way or the other there. And if we set these price slices back to our typical, we like to look at what happens if we have a 1% pop open in the morning or a 3% decline. So if we had a 1% gap open in the morning, it would take us right up around that 2040 level. And if you recall from the daily chart, that's that unfilled gap from the beginning of the year. 2040 is right here. And that's also our upper expiration break even. So you can see that as well. If we trade up and through this level, kind of hold above that 2040, I'm going to be looking to add a butterfly. And what I'm going to be looking to add is probably going to be the 2020 centered butterfly with 65-point wings as well. On the downside, a 3% decline would take us down into the neighborhood of 1960. And we're still going to be within the body of the butterfly at that point. 1960 would be down somewhere right in here around this, this previous high that could potentially act as some short-term support. We'll see if that happens. It also corresponds roughly with this rising 20-day simple moving average. But on the upside, we have a little bit of room to run. It's certainly higher that we're going to push up and through this level. I think, even up maybe to 2060 is possible. And if we see that or we have that happen, we'll just go ahead and add another butterfly up here, stretch out the tent. One thing that I'm going to be doing differently on the SPX butterfly as opposed to the RUD is I'm only going to be trading it up to 2 butterflies in size. So I'm going to add another butterfly, say here at 2020, for example. And beyond that, I'm going to be rolling up the lowest butterfly. And due to the width of the butterflies, you start running into some of these overlapping issues. And really, as you get further and further out here, the lower butterflies aren't going to be doing us any good. So if we had a butterfly at 2020, maybe stretches our expiration break even out to about 2060 or so. Well, by the time we've reached that 2060 level, so we're way out here, essentially, or I guess that's 2068, but say we're 2065-ish, when we're at this point, this lowest butterfly down at 1990 is starting to not do us very much good. So once we reach that point, we're going to go ahead and just close that out and move it up, and then we would have a butterfly centered at 2020 and somewhere above that, depending on where the market is. But at any rate, that's all I have for today. If you have any questions, and I'm sure some of you probably will, feel free to shoot me an email, info@thetatrend.com. I'm a little bit slower to reply to emails right now because I'm on the road and dealing with some family issues, but I will respond to you hopefully within the next couple of days. So thanks for watching, and I hope it helps.